Hello and welcome to Business Lunch. I'm Nisha Podar and with me as always is my co-anchor Pavitra Parekh. Let's begin now with the markets then, and what a good beginning to the markets that we have seen. In fact, global cues had a lot to do with the market performance, and Nifty 50 for the first time after first week of April reconquering that 18,000 level. Remember, it has been at a kissing distance to this particular level several times in the past few days, and especially yesterday. At the moment, high point of the day, Nifty 50 comfortably above the 18,000 level. Sensex also not too far away, 60,588 levels at the moment, and gaining almost 475 points in the market. Bank Nifty, take a look at that. That is showing slight underperformance, but really can't say anything because it's still a 0.5% gain by the financials. And the mid-cap universe is showing slight underperformance as well, 0.3% down. But there is broad-based participation. And on my radar, one particular big heavyweight is Bajaj Finserv, roaring in trade, 4.3% up in trade. And some of the HDFC group companies and the heavyweights, HDFC, along with other heavyweights like Reliance, Bharti Airtel, all adding to the momentum, and therefore the advance decline ratio also in favor of the advances. Pavitra.
Well, absolutely. I think momentum is the key word, right? It took us 5 months, but we're back at that 18,000 mark and, you know, in fine fettle for our markets. If you take a look, by the way, at these past 5 months, the rally has been led in large part by the auto names. So in this period, the auto index, the Nifty auto index is up over 20%. What's not done well, of course, is the IT pack, which is down at, you know, a similar level, around 20% lower on the Nifty IT pack. Today, like Nisha pointed out, it is the Bajaj Twins and HDFC group of stocks which is holding up. I'd also take a look at some of the metal names because the Nifty metal index is the top gainer. So the likes of Vedanta, Hindalco, you also have a JSW Steel, which are all looking extremely strong. On the downside, there are just around 5 or 6 stocks which are, you know, in the red in this otherwise strong market. But a few of the tech names, few of the auto names, and a few from the pharma pack, the likes of Cipla as well as DRL, seeing some cuts. So that's what's really going on with the markets. We're going to come back to this. But another important story today is what's going on with the currency. The rupee has soared over 0.5% to nearly 79 versus the dollar as banks sell dollars. Bond yields started lower in the morning despite a higher than expected inflation print as well. So Lata is here with more on that. Lata.
Well, the clear performer of the morning has been the currency. The Indian rupee is 0.5% higher compared to the dollar. All the other Asian currencies are about, 0.01, 0.02. They are flat. So this is an outstanding performance, and the rupee has gone from 79.52 to nearly 79 to the dollar by noon trades. The reason appears to be a one-off. There seems to be a large, dollar inflow that came into the country some time back. It reached the bank's books. They hedged it, and today the cover ends, the hedge cover. So they had to, sell off those dollars. And that's how the dollars have hit the spot market as well as the NDF market. So this is a bit of a one-off, though you have to admit that there are the longer-term positives, which is that equity flows have started, bond flows are expected to start when the bond inclusion happens, and the dollar index also is off its highs. So generally, it's a pro-rupee scenario or a pro-EM currencies, but this one-off buy contract, which banks are reversing today, is the one that is created this huge rally in the rupee today. We shouldn't expect this ferocity of the rupee rally to continue, but generally there is a bit of a pro-rupee or a pro-Asian currencies syndrome because of the feeling that the dollar has peaked off. Bond markets again was a surprise performance. Bond prices were higher and yields lower in early morning trade when you would have actually expected the opposite, because the August inflation was higher than what the street expected. CNBC-TV18 poll was expecting 6.84. It has come in at 7. It's also higher than the 6.71 of July. And food inflation was definitely higher than what the economists were prepared for. Nevertheless, the market is not even ruffled, and that's because it's only looking at one thing, the inclusion in the bond index. The meeting should be about 3 to 4 weeks from now, and the JPM Bond Index Committee. And the expectation is that they will announce the inclusion, although it may be deferred maybe by 6 months or something like that. The other important point is, in spite of the higher than expected inflation, most of the economists, especially I want to refer to 2 economists, the ones from SBI and Citi are expecting that RBI will hike maybe at best by 35, but more likely by only 25 basis points compared to that 50 and 40 basis that they were hiking in the last two monetary policies. The reason is that already one front-loading has happened, but more importantly, the way in which the finance minister spoke a couple of days back, seeing that the centre is also picking up a lot of flack on inflation, as well as some dovish comments coming in from the MPC member Ashima Goyal.
All right, Lata, thanks so much for all those details. Not just good day for the equity markets, but even the money markets today. Shifting focus to some important macro cues then, and India's CPI inflation for the month of August spiked to 7% from an earlier 6.71% in the month of July. Now, the food inflation also came in at a 7.62% versus 6.75% last month. And meanwhile, India's factory output, or as we know it, index of industrial output, witnessed a 2.4% growth in the month of July. Let's also hear out a word from India's Chief Economic Advisor V. Anantha Nageshwaran, and he expects the food prices to moderate going forward and also believes that India's inflation rate remains at manageable levels. Let's listen in.
This is to be expected given the base effects that indices normally face, and the market is also probably overreacting, the food markets, to the possible lower sowing on the rice crops, and therefore building in some expected shortage, and therefore the prices are reacting in advance. But as soon as the market comes to know that there are adequate food grain stocks and that the sowing shortfall isn't as big as is being made out to be, then I expect the current spike in the food prices to moderate themselves over time. India has weathered the monetary policy tightening in developed countries very well, and I think financial markets are also quite aware that India has a fairly resilient economy. And while we are concerned about 7% inflation, and rightly so, we must remember that compared to what other countries are going through, our inflation rate is highly manageable and in the middle level of the range that we are experiencing across developing and developed countries.
All right, that is the Chief Economic Advisor saying that he's not really too worried about the retail inflation right now, and that India's inflation does seem quite manageable to him. But with that, let's move on and talk about the big global macro cue to track today. The US August CPI will be released later today, and it is expected to show that inflation is moderating. So CNBC's Jeff Cutmore is here with all of the expectations.
US consumer inflation expectations eased again in August, according to the New York Fed survey. American consumers see inflation at 5.7% over the next 12 months. That is the lowest rate since October 2021 and down from 6.2% in July. Today's inflation print is expected to show US CPI rising by 8% year on year, according to the Dow Jones forecast. However, price pressures are expected to ease on a monthly basis, falling by 0.1% in August as against July. Well, despite the forecasts, many investors still see the Fed delivering a third consecutive 75 basis point hike at its meeting next week. The Fed chair, Jerome Powell, has previously said his goal is to, quote, get wages down and then inflation down.
All right, containing inflation, that is the big task. With that, we'll slip into a short breather on Business Lunch. But when we return, SEBI chairperson Madhavi Puri Budge says that 100% transparency is required to build trust in the capital markets. We get you more after this short break. Don't go anywhere.
Welcome back. You're still tuned into Business Lunch, and let's bring you some important comments that came through from the finance minister earlier today. She says she sees big potential for manufacturing with high interest in relocation from China. She also asked India Inc. why they are hesitating in ramping up investments. So here are some interesting snippets from their finance minister. Listen in.
Hearing a lot more companies who are moving out of China wanting to come because they find the policies a lot more attractive, not just the PLI, but overall the ecosystem is now far more facilitative of such companies coming out to locate themselves in India. If that is one of the things. The second, I think, no policy can be the end to itself. It's not as if we've given a solution and that's the end of the story. It keeps evolving as we go on. Government is willing to hear you, willing to have conversation with you. You should utilize every one of this opportunity and also seek the opportunity to speak to the government and say, look, you're not doing this, you should, it'll make a difference. And I think that's been the approach, that's been the difference in approach between any government earlier and this government. We are willing to hear, listen, talk to you, and also act on what you've given us. So in order that India does not miss the bus this time, support to the MSMEs is not just what government can give. It is certainly largely dependent on that. We wanted payments to go to the MSMEs in due time and not be delayed. And there was a time when, there was public, there was a figure floating around in the public. But I was surprised to find a considerable due payment, pending payments were also from the big industries. Now I can push my PSCs, I can request states, I can make sure departments pay up, I can only appeal to the industry. For all the tears that we shed for the MSMEs, my tears, your tears, can we limit the time by which the MSME will get its due?
All right, so that's the finance minister of the country. And shifting focus then, SEBI chairperson Madhavi Puri-Buch pushes for building immunity in the capital markets and says that 100% transparency is needed to build trust. Take a listen.
We are a disclosure-based regime. If the investor sees that yes, 100 rupees to 450 rupees, nothing has changed, he is free or she is free to make her own decision. At what price you choose to do your IPO is your business. We have no business to suggest otherwise. A lot of what our regulations say is really not just, and particularly disclosure, is not just for the protection of the investor, it is for the protection of the entities raising capital as well. Because nobody tomorrow should point a finger at you and say, you did not disclose this, and we were misled into investing in your company, and now there is a problem in the transaction. So the simple premise of saying full disclosure protects both the discloser and the disclosed. Both parties are protected, and this is the spirit in which we believe in the concept of 100% transparency and disclosure. Front running, insider trading, information asymmetry, fraudulent transactions, manipulation of stock prices, these are all our versions of polio and smallpox. We need to build immunity. Therefore, it is with this spirit that I earnestly request each one of you that when SEBI comes up with a regulation, to take it in the spirit of saying that we are attempting here to build immunity in the entire ecosystem against our own versions of polio and smallpox.
All right, some important comments coming in there from the SEBI chairperson. But with that, we have to get into a short break now. On the other side, the IRDAI, the insurance regulator, has asked companies to dematerialize all policies. What will the fallout be for depositories as well as insurers? We have a complete explainer lined up for you when we come back.
Welcome back. You're watching Business Lunch. A quick look at the market. Yes, Nifty 50 holds on to the gains that it is maintaining at the moment, closer to the high point of the day. Bank Nifty is 0.5% up. Some of the financials like State Bank of India, IndusInd Bank are on my radar. They have perked up in last few minutes of trade. Now, as reported earlier on CNBC-TV18, the insurance regulator IRDAI has mandated that all the insurance policies be dematerialized. Now, we have Yash Jain with us with an explainer on who benefits from this particular move and the costs involved for the insurance companies.
CNBC-TV18 had reported on September 6th that the insurance regulator was considering mandating that all insurance policies be dematerialized. On the 7th of September, we told you that the mandate has indeed come through. Let's now dive deeper and look at the big beneficiaries of this move and the cost involved for insurance companies. Let's spend a minute to look at what this dematerialization move really means. All new policies issued from December 2022 will have to be compulsorily issued in a demat form. And by December 2023, all old or existing policies will have to be brought on the demat platform. Many relate this move to the dematerialization of shares. The move would mean converting physical insurance policies into modifiable online policy. Insurance policies will be put on a separate demat platform called the EIA, or the Electronic Insurance Account. This EIA will have all policies belonging to an individual, like his life insurance, health insurance, or motor insurance policy. What does it mean for policyholders? Since all policies belonging to an individual will be in one account, servicing these policies can be done all at once rather than reaching out to individual insurance companies. Dematerialization will remove paperwork and physical policies. Finally, policyholders will be able to take loan against their insurance policies just like they do against shares. Now, let's get to the meat of the story. Who benefits? Well, in long run, this will benefit insurance companies, but the depositories are the ones who enable this process, and they will be the big beneficiaries. NSDL, CDSL, CAMS, Carvi are the big depositories analysts are focused on. My calculation suggests that the depositories here could have an opportunity to double their revenue. Why do I say that? Life insurance industry sold around 3 crore policies in FY22, and the cost of dematerializing a single policy estimated by insurance companies and industry experts is around 50 to 60 rupees per policy. That would give depositories an additional revenue of about 150 to 180 crore rupees. General insurance companies, they sold 50 crore policies last year. The same calculation on dematerialization cost will give depositories an additional revenue of 2,500 to 3,000 crore rupees. Finally, the old active life insurance policies will also have to be dematerialized. There are 30 crore life insurance policies, and dematerialization of these policies will bring revenues of about 1,500 to 1,800 crore rupees. All put together, there could be additional revenue of around 4,150 to 4,980 crore rupees for the depositories. Compare this to the current revenue which depositories make. NSDL's revenue in FY22 stood at 821 crore, CDSL's revenue stood at 606 crore, and CAMS was about 927 crore. A very conservative estimate would show that these depositories could easily double their revenue. Now, insurance dematerialization will certainly entail a cost for insurance companies. This right here is a breakup of the annual recurring cost and the one-time cost which big insurance, both life and general, will have to take towards dematerialization. On the positive side, insurance companies will save the printing and the delivery of physical policies. Dematerialization will also restrict frauds. Also, it will improve the renewal ratios and hence the persistency for these insurance companies.
Yash, thanks a lot for explaining that to us and taking us through what dematerialization of insurance policies could really mean, as well as the impact that we could see on some of these depositories. But with that, we have to move on and bring you some grim news which is coming in from Telangana. At least 8 people have died after a massive fire engulfed an electric bike showroom in Secunderabad. All the victims were staying in the lodge above the showroom. The cause of the fire is yet to be ascertained, and all electric bikes in the showroom were gutted as well. Expressing his condolences, Prime Minister Narendra Modi announced that rupees 2 lakhs would be paid to the kin of the deceased and 50,000 rupees to the injured.
All right, quite a grim picture there. But with that, I'm afraid it's curtains down on this edition of Business Lunch. But stay tuned to CNBC-TV18 Midcap Radar comes up right next. Thanks so much.